Well, good morning. It's Michael Douville coming to you from beautiful Phoenix, Arizona. It is October 3rd, 2020, and this is another Creating Real Estate Wealth production. Now, as you know, on Tuesdays we have a live webinar and we talk about financial topics. Last week was diversification, and it invariably gives us additional questions. Now, I had talked that there was some risk in portfolios, and that's why we diversified. The diversification is a risk mitigation. I talked about the fact that bonds for the last 3 or 4 years have been at risk. Now, there is an inverse relationship with bonds. So as interest rates go up, bonds go down, and vice versa. When interest rates go down, the value of bonds go up. We're at a 5,000-year low, which means that interest rates, unless we go negative, probably aren't going any lower. So if they're not going any lower, they're not going to stay low forever. And if they start going up, they're going to start losing money. And of course, you can lose significant money. If it just went from 0 to 2 on a bond, that's a pretty big move. Now, also, we're coming through a recession. Now, we're recovering, but we're not recovered. And bonds are basically loans. So many companies have borrowed money. If the company is struggling, and there's a lot of companies that are struggling. I mean, you hear about the malls, you hear about the hotels, you hear about the restaurants. These are all struggling. If they can't make their bills, they're going to default on their loans, which are defaulting on their bonds. That's a credit risk. So bonds have a risk of default. That's a very significant loss because you could lose it all. So there are times when your portfolio is at risk if you have bonds. We're probably in one now. You should probably discuss what type of bonds you have with your financial advisor and see what kind of risk that you're running. I would say if you look at your bonds, they're an income source for you, and the function of a bond in a portfolio is to consistently give you income. You can get that going into single-family homes in one of the great markets of the United States, that would be Florida, Texas, or Arizona, and become very, very conservative. Now, you do give up some liquidity because real estate is not anywhere near as liquid as a bond, but in this part of the cycle, it's probably a very, very conservative and perhaps maybe less risky than a bond would be. It will certainly send you more income than what you're receiving in most of these bonds. And you could, again, talk to your financial advisor and explore that. There would be a great diversification. Real estate is also oftentimes counter-cyclical. So in your stock portfolio, when your stock portfolio is having trouble, which is often the case when we're in a recession, because they are sold on earnings, and earnings during recessions suffer. Real estate is counter-cyclical, and we've seen that in the real estate business in the last 6 or 8 months. The real estate business has done exceptionally well. As the stock market struggled, real estate has gotten better. They're counter-cyclical. Also a nice balance and a very, very good diversification for your total portfolio. I would also bring this to your attention that the S&P and some of the NASDAQ have been really pushed higher by a very limited amount of stocks. Facebook, Netflix, Amazon, Apple, Microsoft, and you've seen Tesla. These have had enormous runs. Sometimes you want to talk to your financial professional and see if you shouldn't take some profits in ones that have really run, because oftentimes they go up and then they come down. What would be really nice is to take some profits and move it into either staying into that asset class again and diversifying within that asset class, although maybe it's a little bit at risk, but that also could be used as a source of funds to move it into real estate, which at the moment is a very, very compelling investment. So talk to your advisor. You may have stocks and bonds that are at risk. To find out what kind of risk that you have. And if you're at risk and you still want income, you can move into one of the great markets of the United States, get income and growth, because these markets are growing very, very well. We have in-migration coming in Florida, in-migration in Texas, and lots of housing pressure in Arizona. I mean, Arizona here in Phoenix, we have a housing shortage, so rents have been going up and prices have gone up, and it's probably a decade-long trend. So you get both safety of principal. I think your principal is going to be better here, not guaranteed, but pretty conservative. Get income and growth of your growth of appreciation. Now, if we can help in any way, if you just like to talk to us, we're more than happy to talk to you, your spouse, your advisor, your accountant. We're more than happy. We're very, very good at what we do. We're more than happy to broach these topics with anyone that you'd like. You're welcome to reach me at michael@michaeldouville.com. You can call me at my office here in Phoenix at 602-942-4200, and we can set up some kind of time where we can talk. And I wish you my very best. Bye-bye now.